Hi everyone, I'm Lorenzo Di Mattia, manager of Hedge Invest Sibilla Macro Fund. I wanted to describe what happened in September and give you the outlook for the rest of the year and next year. September was a difficult month for a lot of hedge funds, and we've been very light. We managed to be almost flat for the month. And the reason we've been light is that there's been a severe dislocation in markets, especially within sectors and factors. The best positions for the year went down the most, while the most fundamentally sound shorts rallied. And we recognized that in late August, and we decided to liquidate our book because it's very hard to find good longs and good shorts during such periods of dislocations. Also, the US economy is slowing down finally, and the slowdown is not only in the manufacturing sector, but is spreading to the service sector as well. On the other hand, it was not easy to short outright because there are two potential positive catalysts upcoming. One is the Fed, and the other one is the trade deal with China, which is a question mark at this point, but a limited deal is still possible and could rally risk assets further. As I mentioned before, the US economy is slowing down significantly, including the service sector, and this will lead to earning decline sometime in the fourth quarter and into next year. So this is a big negative because we've seen what happened with earning decline in the past and overseas in emerging markets and Europe. Not even QE helps to rally stocks and risk assets in general. Now, we do have QE starting in Europe in November, and we also believe that the Fed will start expanding the balance sheet. Announced that in October at the meeting at October 30th. It's important, however, to account for the size of these QEs. So the ECB is buying 20 billion a month versus 80 billion a month in the past. So it's a QE, but it's very small. It's a quarter of the size versus the past. Still, it will probably increase at some point, but for now it's not that big. And the Fed will probably, our base case is for around 400 billion of balance sheet expansion, mostly on the liability side. Now, this seems significant. However, we need to also consider QE3, the last QE in the US, started in 2012, was 1 trillion. And also, issuing from US Treasury, given that debt is much higher now and budget deficit is much higher, is going to be $1.1 trillion. And back then it was less than 500 billion. So the net infusion of cash during QE3 was a positive 500 billion. Right now, it's going to be negative still by 600 or 700 billions. This is important to mention because the QE that will rally risk assets in a sustainable manner will have to be much bigger than in the past. We're talking about 1.5 trillion or more. We're not there yet, so we believe that this month the market will be very choppy in a very nervous trading range and possibly rally somewhat into October, into the Fed meeting. But after that, I think market participants will do the math and the market will start at 10-15% correction, maybe even more, and we're ready to exploit that correction. During October, we will be very tactical and very light because of all the confluence of all these positive and negative elements. Thank you very much.